Powell and the world's central banks are about to slash rates again in 2026. The last two times they did this, they created massive asset bubbles followed by brutal crashes. The 1% are doing the exact opposite. Their countermove is already in motion, and today I'm handing you the blueprint so you don't get caught in the trap. Hey everyone, welcome back to Wealth Architect. I'm Dr. Ben. You've been told the safe play is to park everything in stocks and bonds and ride the next rate cut wave. That's exactly how most people lose years of progress in a single downturn. Here at Wealth Architect, we don't follow the retirement lottery ticket plan. We study the actual blueprints the wealthiest families and funds have used for decades to come out ahead when the system resets. If you're tired of watching your portfolio swing like a pendulum every time the Fed blinks, stick with me for the full episode. By the end, you'll know the complete history that repeats every cycle, exactly what's coming in 2026, the documented moves the 1% have already made, and 3 complete systems you can start building this month. Each system includes the exact numbers, real-world examples, step-by-step actions, and common mistakes to avoid. This is the kind of detail that turns knowledge into real cash flow that lasts. Let's dive straight in. We are going to walk through this in a clear, logical order, so every piece builds on the last. First, we look at the full repeating pattern from history with exact numbers and outcomes. Then, we examine the 2026 setup with current data and what the market is pricing in. After that, we review the actual positioning the 1% have on record right now. Finally, we break down the 3 complete moves you can copy, each one with multiple real examples, precise calculations, implementation checklists, and ways to scale them over time. This structure gives you the full picture, plus every tool you need to act. Let's start with the repeating pattern that is played out every single time central banks have cut rates aggressively. I want you to see the timeline, the numbers, and the outcomes so you never have to wonder why your portfolio behaves the way it does. Go back to the early 2000s. The Fed cut the federal funds rate from 6.5% all the way down to 1% between 2001 and 2003. Cheap money flooded the system. Mortgage rates dropped sharply. Regular families were told this was the perfect time to buy a home because prices only go up. By 2006, median home prices in many markets had doubled from 2000 levels. The S&P 500 climbed on the back of easy credit. Then the housing market turned. From October 2007 to March 2009, the S&P 500 fell 57% peak to trough. Home prices nationally dropped 30% on average, and in some cities the decline exceeded 50%. Millions lost their homes to foreclosure. Retirement accounts that looked healthy in 2006 were cut in half. Meanwhile, the largest funds and family offices had begun rotating into cash, short-term treasuries, and select commodities as early as mid-2007. They sat on the sidelines with dry powder and bought quality assets at distressed prices once the panic peaked. Next cycle, 2008 through the 2010s. After the crash, the Fed took rates to 0 and kept them there for 7 straight years. Liquidity poured into stocks, bonds, and real estate. The narrative again was, don't fight the Fed, buy every dip. The average investor loaded up on index funds and watched them rise. But by 2015, commercial real estate valuations were stretched, and many corporate balance sheets carried record debt. When the next shock arrived in 2020, the system was already fragile. The 1% had quietly increased allocations to private equity, farmland, and inflation-protected infrastructure deals throughout the late 2010s. When the 2020 crash hit, they were ready. The broad market dropped 34% in a single month, but those who had positioned early in cash-flowing hard assets saw their income streams hold steady while prices eventually recovered. Now, the 2020 pandemic response. Rates slammed back to 0 within weeks. Stimulus checks and unlimited QE pushed stocks and crypto to record highs by late 2021. The message was the same. The Fed has your back.
Regular investors piled into growth stocks and meme assets at peak valuations. Then inflation hit 9% in 2022. The Fed was forced to hike aggressively, and the market gave back all the gains and more. The S&P 500 fell 25% in 2022. Bitcoin dropped over 70% from its high. Growth stocks with high valuations lost 50 to 80% in many cases. Once again, the pattern was identical. Cheap money creates a sugar rush, valuations detach from fundamentals, and the late arrivals pay the price when reality returns. The 1% had already begun shifting capital into private equity, farmland, and commodity-linked investments by late 2021, well before the public narrative changed. That is the full cycle you have now seen 3 times in 25 years. Each time, the sequence is the same. Rate cuts create easy credit. Easy credit inflates asset prices beyond fundamentals. The bubble pops, and only those who prepared ahead of time keep their capital intact and actually buy the bottom. The difference between the winners and everyone else has never been luck or timing the exact day. It has always been preparation and ownership of real cash flow assets that do not depend on the next bull market. Now let's bring that same lens to exactly what is lined up for the rest of 2026. Right now, the federal funds rate sits between 3.5% and 3.75%. Inflation has moderated from the 2022 peak, but remains sticky between 2.5% and 3% because of energy costs, supply chain pressures, and geopolitical tensions that keep commodity prices elevated. Market pricing, as reflected in Fed funds futures, is already baking in at least 1 and possibly 2 rate cuts before the end of the year if employment data or GDP growth shows any softness. Powell has stated on record that the committee stands ready to respond if the data weakens. Wall Street research desks are publishing notes telling clients this is the buy signal of the decade and that rate cuts will propel stocks to new all-time highs. Here's what almost no mainstream commentary is highlighting. When those cuts actually arrive, the wave of fresh liquidity will chase the exact same crowded trades we have watched before. Mega-cap technology stocks trading at elevated multiples, commercial real estate portfolios still priced near cycle peaks, and high-yield corporate bonds that suddenly look attractive again on lower benchmark rates. That creates the setup for the next bubble. When the inevitable correction arrives, the typical investor who followed the buy the dip and hold index funds advice gets hit twice, once by buying at inflated prices on the way up, and again by forced selling or margin calls on the way down. Your retirement accounts drop, your home equity shrinks if you bought at the wrong moment, and any side income you hoped would appear never materializes because you were waiting for the perfect market signal.
The 1% already see this sequence unfolding. They're not waiting for the official announcement. Their moves are already documented in public filings, quarterly letters, and earnings transcripts you can read yourself today. Let me show you the concrete evidence. Warren Buffett's Berkshire Hathaway is currently holding more than $189 billion in cash and short-term treasuries. That is not a sign of fear. It is deliberate preparation to deploy capital when the reset creates genuine bargains in quality businesses. Bridgewater Associates and several other major macro funds have been increasing exposure to commodities, gold, and inflation-linked real assets steadily since the second half of 2025. Blackstone and KKR have each raised hundreds of billions for dedicated direct lending and infrastructure funds that are locking in 8 to 12% cash yields on deals closed before rates fall further. Family offices of the ultra-wealthy have been acquiring cash-flowing farmland under long-term leases, industrial warehouses with triple-net tenants, and private credit notes that deliver monthly or quarterly payments regardless of what the Fed decides next. These are not opinions. These are positions already on the books, reported in 13F filings, investor letters, and conference presentations from the past several quarters. They are building income that survives volatility instead of depending on market appreciation. So what does this mean for your own capital right now?
It means you have 3 complete systems you can begin building immediately. I'm going to walk you through each one in full detail. The why, the exact numbers that matter, multiple real-world examples, the step-by-step implementation plan, the common mistakes I see people make, and how to scale each system over the next 12 to 24 months. These are not theoretical ideas. They are the exact approaches I use with my own capital and share with the private clients who work directly with me. Build your own cash flow engine with productive real assets. The core problem most people face is that their wealth only grows when the stock market cooperates. Productive real assets solve that by delivering cash every single month, no matter what Powell does. Start with the numbers that matter today. A well-chosen 4-unit multifamily property in a stable employment market can be purchased for around $650,000 with 25% down. Current market rents in that range typically cover the mortgage, taxes, insurance, and maintenance, while still leaving approximately $2,800 per month in net cash flow after all expenses. On a $162,500 cash investment, that equals over 20% cash-on-cash return before any appreciation. Compare that to an S&P 500 index fund that might yield 1.5% in dividends and can lose 30% in a bad year. Here's a second example using farmland. Prime row crop land in the Midwest, leased to an established operator, can deliver 6 to 8% net cash yield on purchase price right now. A $500,000 parcel might generate $35,000 per year in lease income with very low ongoing costs. When rates fall, any debt you carry on that asset becomes cheaper, but your lease payments stay fixed or rise with inflation adjustments built into the contract. Implementation checklist you can follow this month. Step 1. Open your local multiple listing service or LoopNet and filter for properties that already have tenants paying market rents. Step 2. Run the full cash flow model yourself. Gross rental income minus all operating expenses minus debt service. Target at least 1.25 times coverage on your mortgage payment. Step 3. Contact 2 local commercial lenders and ask for current rates and terms on multifamily or agricultural loans. Step 4. Schedule physical visits on at least 2 deals that pass the cash flow test. Even if you begin with a single-family rental or duplex, the principle is identical. Own something that pays you while you own it. Common mistake to avoid: chasing price appreciation instead of cash flow. Many investors buy at the top of the market, hoping values keep rising. Focus first on the monthly income the asset produces today. Scaling plan. Once you own your first property, use the cash flow plus any refinance proceeds to buy the next one. Within 3 to 5 years, you can realistically build a portfolio generating 5 to 6 figures in passive income that continues regardless of rate cycles. Create an economic moat inside your own business or side venture. The wealthiest individuals never rely solely on Wall Street for their upside. They own the actual cash flow machines. Take the skill, knowledge, or network you already have and package it into a scalable offer that delivers 20 to 40% margins with recurring revenue. Real example. One person I know runs a logistics consulting practice for small manufacturers. He charges $8,000 per project and maintains 3 monthly retainers at $2,500 each. His entire operation is supported by 1 virtual assistant. Annual revenue exceeds $180,000 with 65% net margins. When rates fall and capital becomes easy, new consultants enter the market, but his clients stay because he has 18 months of documented results and a referral system that brings 2 new leads every quarter without advertising spend. Your 30-day action plan. Week 1. Write down the single problem you solve better than anyone else in your industry or niche. Week 2. Price a clear offer that feels like a no-brainer to your ideal client. Week 3, create a simple one-page document that explains the offer and the results it delivers. Week 4, reach out to 10 people in your existing network who already know and trust you. Deliver the offer and collect feedback. Common mistake to avoid: trying to build everything at once. Start with one offer that solves one specific problem. Once it's profitable, add the next layer. Scaling roadmap. Move from one-time projects to monthly retainers, then to group programs or automated digital products. The goal is to reach $5,000 per month in semi-automated income within 6 months. That single stream then becomes your personal central bank, steady cash that doesn't depend on market conditions. Position for asymmetry with private credit and direct deals. Public markets receive all the attention, but the strongest income during a rate reset period comes from private credit, lending directly to solid businesses at 9 to 14% yields while benchmark rates fall. Concrete numbers. A typical 12 to 24-month private credit note in equipment or infrastructure financing might pay 11% annually and be secured by assets worth 1.5 times the loan amount. If you allocate $50,000 across 3 diversified notes, you can expect roughly $5,500 in interest payments each year, distributed monthly or quarterly, with principal returned at maturity. Compare that to a 10-year treasury yielding around 4% with full exposure to future inflation risk. Immediate action steps. First, confirm your accredited investor status or explore the available structures that fit your situation.
Second, review 2 platforms or syndicates that specialize in private credit. Compare yield, term length, collateral quality, and payment history. Third, begin with a test allocation, even $10,000, into a single note to become comfortable with the process. Fourth, repeat the allocation every quarter as additional capital becomes available. Common mistake: treating private credit like a stock trade. This is income-focused lending. Focus on the collateral and the borrower's cash flow, not short-term price movement. Scaling approach. Once you have experience with 3 to 5 notes, increase position size and diversify across different sectors. Many participants reach 6-figure annual income from private credit within 3 years, while the principal remains protected by real assets. Each of these 3 systems puts you in control of cash flow and timing instead of hoping the market moves in your favor. When the next cut cycle follows the same path we have seen before, you will not be staring at a dropping portfolio. You will be receiving rent payments, business profits, and private interest income while others react in panic. Let's bring everything together one last time. You now have the complete repeating history with exact outcomes, the precise 2026 setup based on current data, the documented moves the 1% have already executed, and 3 fully detailed systems you can begin building immediately. Each system solves a core wealth problem: lack of steady income, dependence on market timing, and vulnerability to the next correction. You also have the exact numbers, checklists, and scaling plans so you can move from learning to owning real cash flow assets. If you want the exact cash flow calculators, deal evaluation templates, private credit opportunity lists, and business offer frameworks I use with my own capital and share with my private clients, type Reset Blueprint in the comments right now, and I will send you the complete free resource pack. Hit subscribe and turn on notifications because every single week we release another detailed blueprint that actually moves the needle for your financial independence. You are not here to follow the old rules. You are here to design your own freedom. I'm Dr. Ben. Thank you for spending this full episode with me. Now go build something that lasts. I will see you in the next one.